The Bank of England has issued a new financial stability report, which they do every quarter or so. And this one is important because it says one overwhelming thing, which is that the risk environment around the UK economy has deteriorated.
Breaking tonight. 3 weeks ago, a report slipped quietly onto the Bank of England's website. No headlines, no political debate, no public warning, just 57 pages of carefully engineered language, buried, muted and wrapped in technical jargon. But when you strip away the diplomatic phrasing, what the central bank actually said is nothing short of alarming. Their message, hidden between the lines, is blunt. The financial system is not prepared for what may be coming. They're seeing cracks, deep structural cracks, household debt at levels that stretch families to breaking point, commercial property valuations collapsing faster than anyone wants to admit, global vulnerabilities tightening like a noose around already fragile markets. They didn't scream it, they can't. Central banks don't shout, they whisper, and when they whisper publicly, it means they're genuinely afraid. The warning wasn't some analyst's guess. It was a rare moment of institutional honesty from the very body responsible for keeping the system stable. They outlined a scenario where multiple failures could erupt at the same time. Mortgages spiking, banks absorbing losses, foreign shocks sweeping into the UK within days, a compound crisis, a chain reaction they might not be able to stop. And tonight we're going to peel back that language. We're going to translate every quiet signal, every cautious phrase, every coded sentence, because once you understand what they're actually saying, you'll realise why this report should have been front page news across the country. Not next month, not next year, the second it was published. This is the moment you stay informed. If you want the truth behind the stability warnings and the breakdown of what the next 2 years could really hold, hit like, subscribe and stay locked in. What comes next affects every household, every mortgage, every job, and it starts now. 3 weeks ago, that quiet, overlooked central bank report didn't just hint at trouble. It mapped out the pressure points of a system creaking under its own weight. And tonight, we dig straight into the heart of their first major warning: household debt vulnerabilities. Not abstract theory, not distant forecasts. But real-world strains sitting inside millions of British homes right now, hidden behind polite spreadsheets and technical phrasing. The report's language may sound measured, but the meaning is anything but. When they say reduced payment buffers, what they're describing is a country where millions are one unlucky moment away from financial collapse. Households are carrying near-record debt loads, stretched thinner than at any point in the past decade. And with mortgage resets accelerating, the pressure is turning brutal. In the past 2 years alone, 2 million households were forced off ultra-low mortgage rates. Payments that felt manageable at 1.8% or 2% suddenly doubled at 5% or 6%. An $800 monthly bill becoming $1,600 overnight, an extra $9,600 a year out of nowhere. Families didn't adjust. They amputated their budgets. Holidays gone, savings gone, car payments paused, emergency funds drained, tens of thousands living on fumes, terrified of the next letter from the bank. And here's the part the central bank buried between the lines: the crisis hasn't peaked. Another 1.5 million households are scheduled to remortgage over the next 18 months. They're sitting on fixed rates that were cheap, comfortable and temporary. When those expire, the same doubling of payments hits again. The question isn't if people will break, it's how many and how quickly. The central bank's stress modelling is blunt. If even 10 to 15% of these households start missing payments, the mortgage market enters a dangerous spiral. Defaults rise. Banks tighten lending. Credit dries up. The economy slows. Job losses follow. More defaults hit. It's not one failure. It's a chain reaction. Each link pulling down the next. Their cautious phrasing masks a brutal reality. By the time analysts finished dissecting the second layer of the report, one theme became impossible to ignore. The cracks emerging across Britain's financial architecture weren't isolated anomalies. They were forming a pattern. A pattern the central bank clearly spotted months before anyone else realised. And buried inside their measured paragraphs was the most alarming translation of all. The system may be one shock away from buckling. They highlighted commercial real estate first. On paper, the language was cautious, adjusting valuations, sectoral pressures, changing work patterns. But stripped of restraint, it meant something far more severe. Whole segments of the commercial property market are collapsing in value, and the banks sitting behind those loans are watching their balance sheets erode in slow motion. Office blocks once considered prime assets now stand half empty, earning half the rent, yet financed at pre-pandemic valuations. It's a silent time bomb, one the public won't notice until institutions start tightening lending overnight. But the report didn't stop there. It expanded outward, pointing at international vulnerabilities with a cold, clinical undertone. They referenced elevated global debt and cross-border spillover risk, which in central bank language translates to if something blows up abroad, the shockwaves will hit the UK instantly. And looking at the global landscape, US regional banks wobbling, Chinese developers defaulting, European lenders carrying massive exposure, the list of potential triggers has never been longer. The UK isn't insulated from any of it. It's wired directly into the global circuitry. Then came the most revealing line in the entire document, the risk of simultaneous shocks. In blunt English, multiple things could break at the same time. Mortgage defaults, commercial property crashes, global contagion, market volatility, credit tightening. They're telling you the danger isn't one event. It's all of them colliding. And this is where the central bank's tone changed subtly. Not panic, not alarm, but resignation. A recognition that while they see the risks building, their toolkit is depleted. They can't simply slash interest rates like before. They can't balloon their balance sheet again without destroying credibility. They can't stop a global... While households brace for impact, a far bigger danger is silently expanding beneath the surface. The structural cracks inside Britain's commercial property market. This is the threat the central bank buried in carefully neutral language, but when translated into plain English, it's far more alarming than most people realise, because this isn't about a few empty offices or struggling shopping centres. This is about an entire asset class slipping into a slow-motion collapse, dragging banks, pensions and credit markets with it if the spiral accelerates. Across the UK, office towers purchased at peak valuations are now worth a fraction of their former prices. Remote work didn't just reduce demand, it permanently rewired it. Buildings once full 5 days a week are now half occupied, with tenants renegotiating leases downward or walking away entirely. Rental income has fallen so sharply that many property owners simply can't service their debt. And when income dies, defaults follow. Here's where the danger multiplies. Banks lent against those old valuations. They believed a $20 million building was safe collateral. Today, that same building might fetch $12 million, and the loan attached to it may still be $15 million. That puts lenders underwater. And while one bad loan is manageable, hundreds of them across multiple banks create systemic pressure. The central bank won't say this is a crisis, but their warnings are unmistakable. They're essentially signalling that commercial property distress is now deep enough to threaten capital buffers, the financial shock absorbers that prevent bank failures. If losses widen, banks will be forced to pull back lending across the entire economy. Mortgages, business loans, credit extensions, all suddenly harder to get. That reduction in credit isn't just inconvenient, it's recession fuel. Add to that the looming refinancing wall. Billions in commercial loans are coming due over the next 24 months, and lenders are refusing to roll them over at anything resembling previous terms. Property owners are staring at rates they can't afford and assets no bank wants to refinance. When financing dries up, forced sales begin. Forced sales drive prices lower. Lower prices trigger more defaults. And around that loop, the system spins faster and faster. This is the makings of a full-scale commercial real estate cascade, and the central bank knows it. They've run the stress models. They've seen what happens when valuations fall faster than banks can absorb the losses. The danger isn't abstract. It's already unfolding. As the dust settles on the bank's warning, one truth becomes impossible to ignore. Britain is heading into a period where the smallest spark could ignite a chain reaction the system can't contain. Every sector, households, property markets, global finance, is stretched thin. The margins of safety that once cushioned shocks have eroded. The buffers have been spent, the slack has vanished. And the institutions tasked with keeping the system steady are now quietly admitting they no longer have the full arsenal they once relied on. Behind the scenes, government departments are modelling worst-case scenarios. Banks are running internal stress tests far harsher than their public disclosures. Insurers are reassessing risk exposure. And large investors, those who always know where the wind is really blowing, are quietly shifting into defensive positions. They're not gambling, they're not guessing, they're preparing, because they can see the same thing the bank can see. The next 12 to 24 months could be the most financially delicate period since 2008, but with far fewer tools available to fight back. For ordinary households, this era will not announce itself with a dramatic headline. It will arrive quietly through higher bills, tighter credit, job insecurity, rising defaults and falling asset values. A financial crisis doesn't start with panic, it starts with pressure. Pressure that slowly becomes weight, weight that becomes strain, strain that becomes fractures, and fractures that, if left unaddressed, become systemic failures. This is why the bank issued its warning now, not to alarm the public, but to alert the attentive, to signal that preparation is no longer optional, to remind the country that resilience is built before a crisis, not during it, and to give anyone paying attention the chance to act before the window closes. Your financial safety will not be determined by luck.